Hello, Finimizers. Happy Thursday. Welcome to another Finimize live event. I'm Stefan, an analyst here at Finimize, and I'm hosting today's event on how to harness the power of options with today's partner, OptionsDesk. Before we start, let me just very quickly run through some housekeeping rules. So please introduce yourself in the chat. Tell us where you're tuning in from. It's always great to see people tuning in from, all around the world, literally. Remember, you have to switch to all attendees so everyone can see your messages. In terms of format, this is going to be a 15-minute conversation followed by 15-minute audience Q&A. So please make sure to use the Q&A box to ask a question, not the chat box, but the Q&A box. And if you see a question you like, you can just upvote it so it moves to the top, and that way we can get through the most upvoted questions first. All right, so let's kick this off. Today's partner is OptionsDesk. Michelle, I think, Michelle in my team, she will be dropping a link to their website right now, so you can have a look. And I'm here today with Managing Director James Proudlock. So James, let's say it as it is. He's a bit of a legend in the world of options. He's got over 30 years of experience at as a CEO and MD and board level with the likes of the London Metal Exchange, JPMorgan, UBS, ED&F, Man Group, etc. So yes, really a bit of a legend, and we're super lucky to have you here with us today, James. How are you doing today?
I'm very well indeed, and a little bit overwhelmed by the introduction. Thank you.
All right, so let's dive straight in. So, just to set the scene a little bit, let's keep it at a high level, but, what are options and what are the different types of options?
Okay, well, look, just at the outset, I really want to thank you very much indeed for inviting me on. And you talked a little bit about my background, and what I want to try to do in today's session is introduce just a little bit more about options than perhaps most retail investors are used to. I think about at OptionsDesk trying to deliver a kind of institutional level of service to retail investors, because these are great instruments, but they're also very dangerous if you don't really understand them. So one thing, if I could just at the very beginning, just talk a little bit about the disclaimer quickly, and if Michelle wouldn't mind bringing it up, just so that I can let people know that what we're talking about today is really informational and educational rather than in any way meant to be investment advice. It's always a challenge when you're talking to a large crowd of retail investors, striking the right balance between simplifying the fairly complex things to the point of perhaps inciting some curiosity, but at the same time not straying too far into the depths of what exactly it is that we're talking about. So if I could just conclude the disclaimer by saying, if you do hear anything that you like and you're interested in and you'd like to follow up further, please do take independent financial advice or just give us a call at OptionsDesk anytime, and then we can go through perhaps things in a bit more detail. But now that we've got that out of the way, I'm very happy to answer your question just about options generally. And really, the building block for options are calls and puts. And simply put, a call option gives the holder or the buyer of that call option the right to buy a particular underlying instrument at a particular price, the strike price, at or before a time that is agreed in the option strike. So it's really the ability to go long of something at a fixed price at some point in the future. A put option is, of course, exactly the opposite. It's basically the right to sell something at a particular price at or before a particular time in the future. And broadly speaking, I think everybody on the call will be familiar with those two basic concepts. Typically, you buy a call if you're bullish, you buy a put if you're bearish. And those are really the sort of basic building blocks from which everything else is generated.
Very nice and straight to the point explanation. Okay, so let me move on to the next question. So, I think a lot of retail traders, they basically just want to use option, as a substitute for buying shares in a way, just as a way to basically bet on price appreciation. But there's so much more things we can do with options. So, what are the other interesting ways that retail investors can use options as part of their investing arsenal?
Okay, well, I think the key really point to start answering that question is that when you buy an underlying security, if you buy a stock or a commodity or a bond, you're basically trading what we call flat price. There's only three things that can happen. It can either go up, it can go down, or it can go sideways, depending on the price direction of that underlier. When you start trading options, there's a multi-dimensional aspect to them. So as well as the price of the underlier moving, you also have the time value of that option. So effectively, you can buy or sell time. You could buy a 0 day to expiry option, which literally is an intraday option. You can typically buy liquid options on, say, US equities out 2 years forward. So you're trading price, time, and the third really important component of an option price is volatility. So when volatility is low, options tend to be cheap because it's an important component. When volatility is very high, then they start getting very expensive. And one thing I suppose it's important to say with those calls and puts is that you can buy a call if you're bullish, but you could also sell a call if you're bearish. In other words, give somebody else the right to buy that security. So in other words, instead of being the client, you are the house making the price. So it's important when you trade options to understand those different, if you like, components that go into making up the price. We typically refer to them as the Greeks, delta being the speed at which the option price moves in line with the underlier, vega being the volatility, and theta being the time. And there's others as well, but perhaps too detailed for this conversation.
Super clear. Thanks a lot, James. So, given everything that's going on around the world right now, super, super exciting time, are there any strategies that you think investors should be thinking about in this environment? Maybe you can give some specific examples of strategies where, options might help.
All right. Well, what I want to do in line with the disclaimer at the beginning of this webinar is perhaps to use last year, 2022, as a proxy for how to sort of look at these markets in a macro sense, and then look at the different strategies as if you've just gone long of a particular security or long of an option, ditto if you were looking to take in premium or you were looking to trade tactically. So if I could ask Michelle just to bring up slide number 3, that might help just explain a little bit what options can be used for and perhaps how they compare with other ways of trading the market. I think it's just about to come up here. Okay, so this is the Dow Jones Industrial Average for the year 2022. And it's quite interesting. If you basically bought it sort of February through February, it would have moved about 0.68%. So you'd have made less than 1% holding it for that period. If you had sort of a look at this chart as you were going in at the beginning of the year, February, you'll see that there's actually been, from the peak in March, a 20% decline down to the end of September, the 30th of September, and then an incredibly quick snap back, 20% in 2 months. And this is something that retail investors really have to think about, because when you don't have kind of unlimited resources of a JPMorgan asset management or whoever it is, you're going to be very, very sensitive to these big movements. And what typically happens is retail investors tend to get a little bit panicky and sell at the bottom, and then it kind of invariably missed the bounce. And then you get whipped out both ways. So options are a good sort of overlay to prevent that happening, if you like. So if you could just go to the next slide, please, Michelle, number 4. So that basically shows you the trade. Had you had perfect hindsight on the 29th of March last year, and bought a put option, this gives you a kind of breakdown of the P&L versus the underlier itself. Now, I do just want to again disclaim that this is with 2020 vision, perfect hindsight. And of course, nobody is ever suggesting that that is the case in reality. This slide really just wants to try and give you an understanding of trading the underlier versus trading an option on the underlier, and therefore the leverage involved in it. But please don't think for 1 second this is actually a sort of, a trading recommendation that we would have made or anything else. So had you bought that at the money put option, it would have cost you $1,650. And that gives you a notional exposure of $35,294. In other words, what the option on the Dow Jones Industrial Average was trading at that time. So had you held it literally to the last day of expiry, again, you probably never would, but that option would have increased in value to $6,600 at expiry, giving you a P&L of the 6,600 less the 1,650, so 4,950. So your P&L on the option would have been 300%. Had you just literally done a CFD, if you like, on the Dow Jones Industrial Average, had you literally just traded that instrument, you would have had a return, had you been long of it, of minus 18.61. So basically the market went down 18.61%, and you could have made with a put option 300%. So if I could go to the next slide, please, Michelle. Thank you very much. So here, this is selling a call option. Now, I am not for 1 second advocating on this call to retail investors that you should grant options. A little bit like CFDs or futures, they have an unlimited potential for loss, but wealthier investors or people that perhaps hold underlying stocks and want to hedge that portfolio, perhaps in a way that they are looking to maximize returns on a income basis, you could have sold, as I said earlier, a call option. So again, if you're bearish, you can either buy a put or sell a call. Selling a call means you're effectively granting somebody else the option. And for that, somebody will pay you, in this instance, for a 6-month at the money call option, $1,700. The notional exposure, again, is 35,294, where the Dow Jones was trading. And because nobody's going to exercise that option at that level, because they could now buy it so much cheaper in the market at the time of the expiry, that option is now worth nothing. It expires worthless. And that's great news for me because I pocket $1,700 of the premium that the buyer of that option paid me. So my P&L in that case is 4.8, nearly 5%. The market has gone down 18.6%. And then the final one, actually not the final one, sorry, slide 5, please, Michelle. So here, this is an interesting one. This is tactical trading, 2020 hindsight, where I'm basically buying a call option now. This is the flip side of that market move, where again, with 2020 hindsight, I managed to go and buy that call option. And I've done a 2-month at the money here. This is the most amount of money I possibly could have taken out of this market last year. I would have paid $850 for that at the money call option with 2 months to go to expiry. And that would have cost me about $850 for a notional exposure of $28,000. Now, that option has accelerated in price so much because of that very quick 20% snapback. At expiry, that option was worth $5,900, giving me a P&L of $5,050 or $594, nearly 600%. So the underlying P&L was 20%. The return on the option with perfect 2020 hindsight was 600%. So it gives you an idea of the gearing there. And Michelle, if we could have the next slide, which I think is, Now, sorry, I think we're done actually. Michelle, take that one down, please, for the moment, and I'll come to that a little bit later. So if I can summarize, there's two things that you use options for. One is the leverage that it gives you, and the relatively small outlay that you have to put down for the economic interest in really a very large amount of underlying securities. And the way that we typically talk to people about how best to use options falls into three baskets. Protection, so you have a big store of wealth and you're worried that there might be a 20% market correction, so why not buy some puts, sleep very well at night, and then if the market does come down, you can see that off a relatively small amount of premium paid, you could get a very big return. If not, it's a little bit like car insurance. You pay £300 a year to insure your car. If you don't crash it, you get nothing back for your £300. If you do crash it, you get 20, 30, 40,000 quid's worth of repairs on that insurance policy. The second area is to generate income. This is the granting of options, selling of options, which we would advise retail investors not to do, but just for completeness sake, it is there. And some people like to grant options on an underlying that they own. We call it covered calls. And then the third thing is tactical trading, where you feel quite strongly that there's going to be a market move within a specific period of time, and you want to use the leverage within that determined time period. I think that might be a little bit breathless and a little bit too much, but just for completeness sake, I wanted to put it all out there.
That's great. And now they've got three potential ways of using options. So I think, they can also just basically go back to the recording and look at any part all over again. So now let's move on to the Q&A. So please add your questions to the Q&A box, and also make sure to vote for the questions you want to see answered first. So let me start with the question here. What option strategies are best to consider during earnings season?
Okay, so great question. And I would say that options trade very actively around earnings season. So for instance, today after the close, we've got Apple and Amazon announcing their results. So let's just take that. Let's say that you think that Apple have literally just begun on the next journey of the metaverse. You think that their GPT algorithms are going to change the world. You think that their visual sets are going to change the way that we start thinking about education and surgery, medical health. You might be incredibly bullish. And you might think this would be a really good opportunity to get long, because you think that earnings consistently surprise to the upside. So there, to buy some short-dated call options on Apple would be a logical thing to do. You just literally think there's going to be a pop on the earnings result. And so you don't want to pay a whole lot of money for time premium. Because you're trading a little bit of time, let's say you're buying a 1 week or 1 month to expiry call option, you're not going to be paying a lot for time. And that's a cheap way to get a lot of leverage and get yourself long. Now, on the flip side, you might think there is so much good news baked into that Apple share price that it's going to be almost impossible for it to exceed the froth of a multi-trillion-dollar market cap, bigger than sort of European stock markets in their entirety. And you think that any slight disappointment in earnings could see quite a big sell-off, as people effectively have bought the rumor, sold the fact, or whatever it is, got out after the results. And there you might do exactly the opposite. You might think, well, what I'm going to do is I'm just going to buy a short-dated put option. Now, the other thing is you might be lucky enough to own a whole lot of Apple stock. And you might think, what I'm going to do now is, because I'm long, I might actually sell some call options at, say, 10% above the current price. We call that a covered call. I think I mentioned it earlier. Then if it does pop up 10% from here, I'm actually quite happy to go and sell some of my holding. But if it doesn't, then happy days, because I just pocketed a whole lot of premium for something that didn't happen. So there are multiple different ways that you can position yourself around earnings season.
Great illustration of the three strategies you just mentioned previously. So next question. James, that's inspiring. Thank you. I want to use options as part of my portfolio, and I like the idea of doing that with someone like you rather than go on a trading platform, doing it myself and lose money instantly. What's the minimum trading / investing amount you're looking at typically for your customers?
Yeah, I'm going to try and keep this as generic as possible and not talk about, my own product. I want this to be as educational and as informative as possible. I would suggest that nobody should really start trading options without a kind of minimum. Let's think of it as a percentage of your net investable assets. And I would say start thinking about maybe 10% of your net investable assets as a kind of options overlay to your overall portfolio. So, and in terms of absolute terms, really less than $10,000, I wouldn't even think about it, kind of around $50,000. So it is worth remembering these are sophisticated financial instruments. One thing I will say, though, is that unlike CFDs, and this is a very important distinction, I saw one question quickly flash up on the screen. What about the losses? And I just want to think about that for that person who was kind enough to ask the question. The loss for when you buy an option is limited to the premium that you have paid. That's it, plus any commission to your broker. But basically, you cannot lose more than the premium that you've paid. Now, when you trade equities and you have a stop loss order, it's possible for the price to gap below your stop loss. And actually, your stop loss isn't triggered until quite substantially below where you thought you were going to get out. With futures, it's unlimited. With contracts for difference, it's unlimited. So although options are leveraged and although they're risky, and although, yes, you can lose all of your premium, you can't lose more than your premium. So I just, in an example I gave just a little while ago, for $850, I had an economic interest in $29,000 worth of Dow Jones Industrial Average. I cannot lose more than that $850. Yes, it's 100% of what I invested, but it's a fraction of the notional economic interest I had.
So this is the perfect way to transition actually in the next question, which is if a put is essentially like a car insurance, why isn't every retail investor educated in having this? Seems like a no-brainer. Fantastic.
That is such an interesting question. So I've worked at UBS, JPMorgan, Man Group. I know, Stefan, you've worked in institutional asset management for a long time. It would be quite unthinkable to run a trading book without using options. But to answer that very, very pertinent question, what happened in 2008 when we had a global financial crisis is that the word derivatives became a very dirty word. And Warren Buffett called them weapons of mass financial destruction. And what you had was everything in the derivative world into one bucket. And that could be mortgage-backed securities. It could be collateralized debt obligations. It could be a whole lot of consumer debt, sliced and diced auto loans and housing loans and retail shopping loans, all bucketed together and given a particular, usually AAA rating on the basis that they were very secure. It turned out they weren't very secure at all. And there was so much over-the-counter derivatives that actually even the Bank of International Settlements in Switzerland had no idea of the systemic risk. And in particular, these credit default swaps, which were meant to pay out if a company went bust. But actually, it turned out that most of them had been written by Lehman Brothers that couldn't fulfill its obligations to pay out when they went. So what happened is that retail, the Financial Services Authorities, it was now Financial Conduct Authority, basically said, because of the leverage, these derivatives should not be used by retail investors. And if retail investors do use them, then we have to make sure that the financial services company providing those leverage instruments goes through a massive disclaimer and a lot of explanation to make sure that that person knows what they're doing. Now, this slightly wraps into the previous question. We don't give people platforms because we think they are too risky. So we called ourselves OptionsDesk.com because the product is a desk. You have to speak to our brokers. You have to go through the trade that you're doing. It has to be explained to you what the risk-reward profile is. The great thing about options is it's very easy to put together a payout diagram for whatever trade it is that the person is looking to do, so that they fully understand the risk and the reward. So the reason that retail investors don't do them is that promoting them, doing what I'm doing, hence the big disclaimer at the beginning of this webinar, goes into the sort of too hard basket for a lot of people. So I either give you a platform, never talk to you, let you do whatever you want, or you have to go through quite a big infrastructure spend and build a business that is effectively human in a world of digitalization. So we've chosen to stay on the right side of the FCA, the Financial Conduct Authority, and of the consumer, who, of course, from Monday, we now have to ensure not only do we treat fairly, but they have to have a good outcome. And that's a high bar for people to cross. And for a lot of companies, it's just too expensive. So you have to be quite niche and quite a bespoke brokerage to provide this kind of service.
If I can just throw my 2 cents here, I think it's really a no-brainer to use options. I mean, it's incredibly powerful, and the flexibility it gives you as a retail investor. I think the issue for a lot of retail investors is it's kind of a steep learning curve, and it appears like too complicated to learn. But honestly, like if I was starting today, I would definitely spend the time to actually learn about options, because in terms of the flexibility it gives you as a retail investor, it literally is a no-brainer. Okay, next question. Does the relationship between options and ETFs differ from equities?
Okay, so it's a really good question. In fact, Stefan, funnily enough, you and I have talked about this before. It used to be that if you were trading single stock or stock index futures and options, it really was kind of limited to the equity markets. And then if you wanted to trade oil or nat gas or gold or corn, wheat, beans, whatever, it was all sort of on the futures side of things. What's happening now is that a lot of those commodities, let's say you were bullish oil or bullish gold, you have so many different ways of trading that now. The underlier could be a single stock like Barrick Gold if you wanted gold, or it could be Shell or BP if you wanted oil. It could be a basket of mining companies that would include perhaps copper and nickel and gold and other mining assets. It could be a futures contract. It could be an options on futures, or it could be an ETF that actually replicates the underlying future. And you can trade options on all of those underlying instruments. So it's incredibly flexible now, however you want to trade it, according to how much risk you want, how much leverage you want, and how important time and volatility are to you. So it tends to be that the option space, because of its time delimitation, tends to be very tactical, i.e. short term. And then those other instruments, if you want to trade the underliers from a diversified perspective, perhaps on a more strategic or longer term basis.
All right, James, I'm afraid that's all the time we have for today. But thank you so much. It was incredibly insightful. I'm sure our audience found it extremely valuable. So thank you so much for joining us today. Thank you everyone for watching and asking all of those super interesting questions. And remember, you can fill out the feedback form that should pop up on your screens now. And well, hope you all enjoyed today's event, and see you at the next one. Thanks again, James. Thanks everyone.
Thank you
so much. Have a great Thursday. Bye-bye.
Bye.